So Module 3, the advanced of bridging finance, this is where we're going to go into a lot more detail around the nuances within bridging finance and just go into a bit more detail about what you need to keep an eye out, and when you're looking at a set of terms, what to keep an eye out for, what to question, what to ask for, and hopefully just go into a lot more detail. So just a quick recap, obviously we've covered what bridging finance is and how it's a short-term solution to bridging between point A and point B, whether it be land without planning, whether it be refurbs, non-mortgageable properties. We've also covered the cost of bridging finance, so obviously the interest rate at around 9-10%, arrangement fees around 2%, exit fee 0 to 1%. Also covered how you can use it for refurbs and auctions, and how obviously the speed of bridging finance is key in auctions especially. And we've spoken about the application process and prepping for your valuation, getting your valuation pack sorted, and making sure that you've got all that information for the valuer to ensure you get the valuation that you're after. And we've spoken through the offer process, the legal process, and how you can ensure that those things go as quickly as possible. And obviously quickly touched on the pros and cons. So in this next module, we'll just cover all that in a bit more detail and cover some of the nuances in a bit more detail as well. So when it all goes wrong, what do you need to think about? What do you need to do? Who do you need to speak to? And what are the options? So when I say about things going wrong, we're talking about going into default. We're talking about running over, cost overruns potentially if it's a refurb, auctions if you're going to run into the deadline. So I suppose the first bit we want to talk about is what to do if it goes wrong during the application process and actually the purchase application. So in terms of when you're going through the purchase and before you've even taken the finance, it's always good to keep a couple of options in your back pocket. So if you've gone for bridging finance, don't just stick with one lender. Keep a couple in your back pocket as like option B and C, just in case you get a down valuation, or they find something in legals, or they change their loan terms, or they change their appetite. These things can happen, and especially if you're mid-auction, is in halfway through your timescale of that 28 days, it can be very easy to panic and to worry and to think everything's going to fall apart. The best thing to remember is bridging finance can be done in a week, 2 weeks. I mean, the quickest one we've ever done is 4 working days. So it can be done really, really quickly. So even if you got into the last couple of days before the auction purchase was due to go through and something catastrophic happened, there's always a plan B and a plan C. The other thing to bear in mind is that even if you hit that 28 days, in theory you should have a 10-day notice period to complete after that as well. So when it gets to completion day, the auction house will then serve you notice to complete. That normally lasts 10 days, sometimes it can be 5 days, but those 10 days buys you an extra 2 weeks, essentially. So keep that in mind as well, that you've always got that kind of week to 2 week buffer at the end as well. And even if they serve notice to complete, once those 10 days are up, they're not obligated to pull out of the purchase. So they may serve you notice to complete, they might let it run the 2 weeks, and you might be on the crux of just about to finish and finalise on the deal, and they might just be able to grant you an extra day or two. But just keep in mind you've normally got that 1 week to 2 week buffer at the end of it. So that's some of the things to keep in mind when you're going through the initial purchase, especially auction purchases, as to how you can kind of manage timescales and everything else. Now, when it actually gets into the transaction, if you're running over, or you think you're going to run over, or if sales are slow, or if the build is slow, just keep that communication, keep it going with the lender, keep it going with the broker, keep everyone informed of where you think you're going to end up, because there's nothing worse than, like we said in previous videos, getting to a couple of days before redemption and then asking for a 3-month extension, a 6-month extension, and the lender is there, having had no communication, having to make a credit decision as to whether or not they want to proceed with the loan and allow it to extend, or whether they want to put you into default. So always keep that communication as early as possible. I would say once you're getting into the final 3 months of your loan facility, if you feel like it's starting to get a bit tight, you need to think about asking for extensions, you need to think about refinancing onto another bridge, you need to think about refinancing onto a buy-to-let, because buy-to-let mortgages, commercial mortgages, they're taking 3 to 6 months at the minute anyway to go through. So you need to be thinking about these exit strategies as early as possible. The other thing that you can do to avoid all of this is actually when you're going through your loan terms at the beginning, if you think it's going to take you 12 months, take 15 months. If you think it's going to take 15 months, take 18 months. Build in that buffer of time, because you're only paying interest for the time that you actually take the facility. So if you take a 15-month facility but only use it for 12, you're only paying 12 months worth of interest. And giving yourself that contingency of time is massively, massively important. So I would always, whenever you're looking through those terms to begin with, understand what their default rates are, understand when the default rates come into effect, understand what the extension clauses are, so how much it's going to cost you to extend, will they extend, how long will they extend for, and more importantly as well, with the default interest rates, some lenders are becoming quite naughty with their terms in that they will actually, if they put you into default, they then have a clause which says that they can charge default interest rates all the way back to the beginning of the loan. Catastrophic if that happens, because you all of a sudden go from paying 10% per annum on your loan to 36% per annum on your loan, and it just completely wipes the deal out. So make sure you understand from your initial terms, from your offer, exactly what happens with the default interest rate, exactly when it kicks in, and how it affects the previous months of the loan as well. And that's how you can avoid a lot of the issues in terms of things going wrong, because actually you preempt them and understand them beforehand and manage that risk to begin with. So whenever you're speaking to your broker, make sure that you get a few quotes to cover obviously different scenarios if lenders pull out. Make sure you understand your extension rights, make sure you understand what happens with default interest rates, and just make sure you understand from the broker's perspective, have they worked with this lender before? Do they have a good relationship with them? Will they be able to get you an extension if you need one? Will they be able to work with the lender to get you through any difficult patches? And just keep that communication the whole way through. But other than that, that should pretty much cover you for when things go wrong. So when it comes to security, bridging lenders are going to take a few different bits of security depending on your deal. So they'll either take a first charge, a second charge, they'll want a personal guarantee, and they'll want a debenture. And depending on whether you've brought private investors into the fold or not will depend on whether they want a deed of subordination. So firstly, your first charge. So this is essentially they register a charge on Land Registry and Company's House, which essentially gives them ownership and control of that property until a point where you pay back their charge. So what it means is they are first in the queue to get their money out. So no matter what happens, they are paid first out of that deal, whether it be refinance, sale, whatever. Any finance that comes into that property, they get paid off first. As the first charge holder, they also have say over whether you allow any further charges. They also have a restriction on title to stop you selling it if they don't want you to. They also can't allow you to raise any more unsecured and put equity charges on it, things like that. So they have full and utter control over that property. So they will take that charge. That gives them the most security out of anything. That is their number one. They will not waver from that at all. So there's no negotiation on that. They will always take a first charge. They may take a second charge if, for example, you've got a property, call it your main residence, for example. So you're going to buy a property, you haven't got the cash to put in as a deposit, but you've got equity in your own home, for example. They may take a second charge over your own home and then use that to raise equity to then put into the purchase that you're doing. Obviously, as we just mentioned with the first charge, if they wanted to take a second charge, they would have to get the first charge holder's consent on your personal house. So if you're with a high street bank, for example, that should be relatively okay. But if you're on a Mortgage Express mortgage, still on tracker rates, then they may not allow a second charge because obviously they want to try and get you to refinance that off that as quickly as possible. So that's the only time they'll really take a second charge, is where you're trying to raise equity to put into something else. The biggest one, and the one I guess that we get the most kickback on, is if you're purchasing in a limited company, they're going to want to take a personal guarantee from any directors and any shareholders over about 20%. So anyone who's got a shareholding in that company over 20%, they're going to have to be on the applications for the loan, but they're also going to have to give a personal guarantee as well. Keep that in mind when you're going for private investment, because if the private investor wants to take a 50% shareholding in the company, for example, for their security, they then have to go onto the loan documents and they then have to sign personal guarantees and everything else. A personal guarantee is a document that you sign which essentially says, I personally guarantee the debt of my limited company. So what that means is that if, for example, on a property that you're purchasing, refurbing and selling, if the lender loses money, and that's the important bit, the lender has to lose money. If they lose money on a repossession, for example, they will then come after the personal guarantee and then would look to essentially repossess your personal assets to pay back the money that they had lost. One of the important things with personal guarantees is that in some scenarios they are capped to a certain amount of the loan. So if it's a £100,000 loan, they may cap it to 20% of the loan, so £20,000 personal guarantee, or they may just ask for 100% personal guarantee. So they'll take a personal guarantee for the full £100,000. Now, personal guarantees, you will need to get independent legal advice, speak to a solicitor, understand what that means for you, speak to an accountant as well, because it depends sort of based on your personal circumstances, where your properties are, how they're held, everything else, as to what they can come after if they ever had to enforce that personal guarantee. But definitely speak to a solicitor, understand what it means for you if that ever has to be called in. We're very lucky, we've never had a client have one called in, but obviously you need to just keep it in the back of your mind that something could go wrong and you may have one called in. The last thing that they're going to get you to sign is a debenture. This is a fixed and floating charge over all assets within your limited company. So if you own your portfolio within a limited company, for example, you then take a bridging loan in that company and you then request a debenture, or the lender then requests a debenture, it goes over everything that's within that limited company. So by taking that bridging loan in the same company as your portfolio could potentially put your portfolio at risk if the lender repossesses the one that you're purchasing, loses money, and then has to come after the assets within the limited company. A debenture is completely unlimited, so they can just keep coming after assets until they're paid back. So that's where you need to be very careful again as to what else is within that limited company structure. Speak to an accountant, because you can set up a group structure, SPVs, etc. to try and protect yourself from debentures. But I would highly recommend getting a good accountant in place who can talk to you about setting up an SPV structure so as to ensure those debentures are over just that individual project and not putting the rest of your portfolio at risk. So well worth looking into that. And then the last bit we very quickly mentioned was the deed of subordination, which is between the first charge holder and the second charge holder. So that's whether the first charge holder in most scenarios is going to be the bridging lender, and the second charge will either be a further bridging loan if you're trying to raise more equity, a mezzanine lender, or potentially a private investor. So that deed is essentially a document between the two of them to agree essentially how they can treat one another and to set them so that they're respectful of one another's position. And the second child holder essentially signs that deed of subordination to ensure that they essentially have no rights to mess with the security of the first charge holder. So they're pretty much all the documents that you're going to have to look at when going for a bridging loan. There may be some other documents that are sort of one-off documents, but as a rule of thumb, those are the ones that you're going to look at on every bridging transaction. So the last section of advanced bridging is title splitting. So for those of you that don't know, this is talking about title splitting in the sense of taking a freehold block of flats and splitting them up and creating leasehold flats, thereby allowing you to access the full value of the property as opposed to the block value. This isn't talking about taking a house with some land and splitting the land off. That's a completely separate strategy that we'll potentially cover later. So in terms of this title splitting, why it's a handy strategy for bridging finance is because if you go out and manage to negotiate on a block of flats that have been listed at their block value, so for example they may have been listed at £800,000, what would happen is you've got them at their block value of £800,000, you then agree with the lender and your solicitor that you will give an undertaking to split that title on completion into leaseholds. By doing that and by saying that you're going to split those leases on completion, it allows the valuer to value it on the aggregate value, so what each of those flats is going to be worth individually and then what they're worth added up. They'll then take that, they'll then give it to the lender. The lender is then able, because you've given this undertaking to split the titles on completion, they will then say, well, you know what, we'll lend off the aggregate value. So the aggregate value of this block of flats might be £1 million, for example. So there's normally about a 20% difference between the aggregate value and the block value. We've seen it anywhere between 10 and 20%. 20% is probably closer to where it's going to be at the moment, however, could be lower. So block value 800,000, aggregate value £1 million. The lender will then lend potentially 75% of the aggregate value, so they'll lend £750,000 against the million. Whereas if they went against the £800,000, it would be 600 against the 800,000. So you can see it makes a massive difference in terms of the deposit that you're putting into the deal. And obviously with the valuation, you've got to be very, very careful to make sure that that undertaking is in place and that the valuer is instructed to do it as an aggregate valuation and not a block value. And this is where getting a good broker who understands title splitting to come in to work with you to make sure that you go to a lender that understands title splitting as well, because it's very difficult to get every single lender to agree to this strategy, because many of them, from a risk perspective, want to work off the block value, But obviously, if you can get them to work off the aggregate value, obviously that's where you can bring your deposits down dramatically. So title splitting has become a massive strategy that we're seeing more of, and especially recently, a lot more inquiries coming through, and a lot more negotiations happening as well, where vendors who've got large blocks of flats, obviously if interest rates are going up, they were on tracker rates, they probably now can't afford to keep them, and now selling off these big blocks. They're probably tired landlords looking to retire, and so at that point they want to just shift off these large blocks of flats, and that's where you can pick up these discounts. So title splitting using bridging finance is a massive strategy that we're seeing more and more of, and I would highly recommend if anyone wants to run through this in more detail and some live scenarios and things like that, then obviously jump on to one of the calls that we'll run at some point, and we'll go through that. And obviously there's the podcast that you can pick up as well, which I'll link in the resources, specifically a podcast around title splitting, and I'd highly recommend going to give that a listen and going through that in a bit more detail in terms of what you can use title splitting for, and how it can be effective for you moving forward.